Dollar General, or DG, has a multi-year history of delivering attractive returns for shareholders. And so when a stock like this has a dramatic drop in just a short period, it gets my interest. You see Dollar General stock down around 40% year to date. So in this video, we're going to talk about what does Dollar General do, a brief overview, why the stock is currently down, as well as my thoughts on where Dollar General can go ahead. If this is your first time tuning in, I'm Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's dive into understanding what does Dollar General do. So one should understand that Dollar General is almost everywhere. There are more than 19,000 stores within 5 miles of approximately 75% of the US population. So they're providing affordable, around dollar priced essentials to many Americans, hence the dollar name. The Dollar General is, you go in and you go, okay, I might need shampoo. It's going to cost around $1. Maybe it's a smaller bottle. Maybe it's a, an off-market brand that I'm not familiar with, or maybe it's just Dollar General's private label brand, but you're going to be able to buy some essentials around $1. Now, this is a convenient value proposition for a lot of consumers because about 80% of their store base serves smaller communities with fewer than 20,000 residents. And you can see it's a small box, a small store size relative to, let's say, the mega stores. So if you don't want to have to drive an extra few miles to go to a mega store that might have a lot more different offerings, but might just say, hey, there's 3 different types of shampoos and that's what I'm going to get. Or there's 3 different types of chips. I'm going to pick from one of those. You go to Dollar General, it's more convenient, and it's only going to cost you around $1, approximately per item that you're going to get. And so you're looking at this and you're thinking, okay, this is convenient. I don't have to go drive. I don't have to go navigate a big store. And that's part of the reason why they have taken share from the big box retailers over time. And, you've certainly seen that in their results. And another key aspect that I like about Dollar General is the recurring nature of this business. Around 80% of their sales are in consumable categories like paper and cleaning products, packaged foods, perishables, snacks, health and beauty products. The reason why this is so important, in my opinion, is that if you do have a recession, the other remaining part of their business, like discretionary goods, that is going to get hurt more. And that is where a lot of other retailers will really get hurt because they have a much higher degree in discretionary good purchases. So when you have that inevitable recession, which I think we have, people will say, yes, it started in the second half of 2023. I think when people look at that, it's consumers pull back on the discretionary items, whereas these consumable categories, these recurring goods, they hold up a lot better. And that's part of the reason why Dollar General has done so well over time, is because its defensive nature is that, okay, well, folks need their food, they need their toilet paper, they need, certain items, and it's recurring in nature, around 80% of their sales in this consumable category. Now, this might raise the question, well, wait a second, if this is around dollar price, per item, who actually has more affordable goods? Because, it doesn't Costco have more affordable goods? So this is the way. It's important to understand there's different business models. So Costco is a subscribers or membership wholesale model where you're buying items in bulk, and then based on these big bulk items on a per unit basis. So based on buying, a bunch of toilet paper, you're getting among the lowest price per unit, but you have to buy in bulk. Whereas a lot of folks that are going to, let's say, Dollar General, they can't afford to go say, hey, I want to go spend, $15 on toilet paper, even though I know on a per unit basis, it's the lowest cost option. They say, I just don't have the budget. I don't have the money to go buy all these things in bulk. Maybe I also don't want to take up all my closet space with Costco size items. And so instead, what I'm going to do is I'm just going to spend, let's say, $1 or $2 to buy, 1 or 2 rolls of toilet paper. And so you have this sort of mentality of, instead of buying in bulk and doing fewer trips, you might use Dollar General to do more frequent trips, and you're working on a smaller budget. A key understanding of the different consumer. And also, if you have a Costco membership, you might be able to be more comfortable, laying out that $100 to say, hey, I'm going to get this membership. Whereas, a Dollar General consumer or one of these dollar store, consumers, oftentimes you're looking at lower socioeconomic, as well as, oftentimes relying on some sort of government subsidy, like food stamps. And so, looking at that, they are affected by government behavior when, like let's say tax refunds go out, as well as, just very sensitive to every single dollar, in terms of what they're spending, even if on a Costco basis has lower cost per unit. Now, recently, Dollar General has been downgraded multiple times following their most recent earnings results. So we're going to want to understand, well, okay, why are analysts cutting Dollar General? They're saying it's no longer as a defensive play. So I turned to AI Ticker Chat. This is a new tool for investors. It's once again, it's AI Ticker Chat. This is a product I recently launched with a partner that uses the most recent cutting edge artificial intelligence models to quickly ask questions. And now it's free for the first month for users to try. The link below if you're interested in trying it out. Where I can ask a quick question like, can you summarize their results and why might Dollar General fall in these results? And it gives a quick answer that I think is very relevant for investors. Look, operating profit decreased by around 1%. Their earnings per share decreased by about 3%. And they also they updated their guidance, really lowering it, where same-store sales growth was only around 1 to 2% for the year. So they're looking at, weaker growth for the year. And they're also guiding to, and this is a key reason why the stock fell, they're guiding to earnings per share decline of around 8% to flat. So whenever you get a guidance saying, hey, we might contract and we might on the high side be flat, that does get investors nervous, because then you're saying, well, wait a second, where is this business going in the future? And growth is a key component of, driving attractive returns for shareholders. And so now when you're saying, okay, this year it might be flat, it should sort of reflect, okay, maybe I'm going to be looking at lower growth in the future, unless they can find something else that sort of turns on that new growth engine. We'll talk about prospects in just a second, but looking at a lower growth stock that's already pretty well saturated in the United States with, over 19,000 stores. And so you're looking at declining results, partly because of higher costs, like higher labor costs. They also talk about a challenging macro environment for their core customers, effectively having trouble, spending more money. They're just not showing up. And so they also talked about the impact of, some years have 53 weeks, some years have 52 weeks. So that impacted the results, as well as higher interest rates. This is one thing I don't particularly care for Dollar General's. They have over $7 billion in debt. I think they should be able to service that debt over time. But you are seeing, because interest rates are higher, you are seeing the cost on that debt move up significantly. And so that is something that's impacting their diluted earnings per share in fiscal 2023 because of higher interest expense. So these are all key data points. Quick summary, if you just want to, quick understanding of what's going on with Dollar General, that's what I did. I asked here with AI Ticker Chat. And when I, dive into the transcript to understand, well, what's going on with Dollar General, management does make a point that it is getting ugly out there for their consumers. Once again, lower socioeconomic for the most part. I mean, you do get some people that say, hey, I just want to go, go to one of these stores and buy some party tchotchkes for around $1 or something. So you do see that aspect. But for the most part, they're talking about macro headwinds having a disproportionate impact on their core customer, talking about seeing pressure throughout the quarter, but really getting worse in April with a same-store sale decline of 2%. And this pressure continued into May. So this is not what Wall Street likes to see. Wall Street likes to hear that you had a problem during the quarter, but it got better. You saying, yeah, it got worse during the quarter, and for what we saw, it continued. So, Wall Street does not like to hear that. And they talk about, once again, our customer who is under greater pressure than we have seen in quite some time. And they're seeing an ongoing mix shift. So effectively consumers, and a perfect example of mix shift is when a customer, historically might, buy steak, and then they say, hey, I can't afford that anymore, I'm going to buy chicken. And so you see that sort of trading behavior, this mix shift with their consumer products, and that does impact higher margin discretionary purchases. And they see, increasing financial strain on our customers as they seek affordable options, increasingly relying on private brands and items at or below the $1 price point. I look at this and I think this does reflect that the macro is increasingly turning ugly in the United States. And for me, it's a warning that it wouldn't surprise me to see broadly, lower equity prices if Dollar General is starting to see this with the consumer. Because when you start thinking about this, it means, okay, And this is a perfect example of the challenges that a lot of companies are facing. You have higher interest costs, from on their debt. You have a weaker consumer because interest rates have moved higher. It's made financing things harder. You have also had inflation that also hits the consumer. So I think it's all finally catching up to the consumer, at least in the second half of 2023. That's what we're looking at here. Maybe starting, May, June. And so I think, what you're starting to see from Dollar General is that things could be getting ugly. Now, where does Dollar General go from here? First, quick plug, I recently bought more of a stock that I think has over 300% upside that I called out to my subscribers at unrivaledinvesting.com. I also expect to raise prices soon, so now's the time to act if you'd like to lock in a favorable rate and take charge of your investment journey. In full disclosure, this is not financial advice. So looking at Dollar General, one of the key questions I often ask myself is this business unrivaled? And when I'm asking, is it unrivaled? I'm asking, do you have a right to win and grow significantly from here? I'm not really seeing a key aspect that would make me go, oh, there's a huge growth driver for Dollar General. I think it probably moves in line with the market. I don't think they have a competitive disadvantage relative to many of the other various different dollar, low priced, options like Five Below, 99-cent stores or Dollar Tree. I think each of these cases you have different mixes. There's also Big Lots, where, folks have an expectation of what percentage of my consumables versus discretionary goods am I going to get. And each of these have different mix. I think Dollar General has one of the highest consumable, so like recurring revenue businesses out there. So that is a very favorable point for Dollar General. I look at them, I don't think that they are at a disadvantaged position. I don't think they're going to be losing significant market share. I think if anything, things probably just hold up and they grow in line with the market over time. But that's a super important point as you think about what's going to drive my return as a shareholder for Dollar General. And I think it's going to need to come increasingly from the free cash flow that they return to shareholders. And that they do have a significant history of doing that, of significant share repurchases as well as dividends. And so that's important to understand, because when you're buying something, you always want to ask, well, where's my return coming from? Is it, a valuation rebounding or valuation expanding? Is it from growth? Is it from cash flow to shareholders? In this case, I don't think you should really heavily bank on growth, and you should focus on what's that cash flow to shareholders, and maybe you get some sort of valuation expansion. Let's talk about that right now, thinking about valuation expansion. So looking at Dollar General, around $34 billion market cap, looking at their sales might grow single digits this year. Their earnings might decline a bit. So overall, you're looking at a company trading around 15 times forward earnings. Their interest expense is significantly higher than where it previously was. The question is, if they're able to stabilize their margins around 8% or even get a slight improvement. And you do see challenges like higher labor costs or higher shrinkage. That means, effectively people stealing things off the shelf. So could they get that under control in the future, get margins closer to 9-10%? That would obviously help the performance of the stock. Recently, it's been closer to 8%, but it'll be a very tight band. I wouldn't expect to see this drop to, let's say, 5%. If that were to happen, that would be very troubling for Dollar General shareholders. Once again, this is a hypothetical valuation framework. Of course, the stock price can go way higher, way lower. A lot depends on their execution. But looking at a business trading what I think is a fair multiple, around 15 times, that is certainly below where the market trades, which is closer to 20 times plus. And thinking about their growth ahead, once again, I'm not putting in a super high growth rate for this business. I think it's growing broadly in line with the economy. And it wouldn't surprise me if the valuation stays where it is, or maybe even, moves up to more closer to a market valuation of closer to 20 times. And I think a big component that's going to drive shareholder returns is the free cash flow that could potentially accrue to shareholders, either in the form of buybacks or dividends. And that, based on the current share price, is around 4 to 6%, depending on what price you're paying and how much cash they're actually, allocating to shareholders versus paying down their debt. So looking at Dollar General, it wouldn't surprise me in my low case that they could deliver, let's say, high single digits over time. So this actually could be a very reasonable return for a lot of investors saying, hey, I don't want to take on a lot of risk. They do have to pay down their debt over time. So that is something to be mindful of. But looking at a business that, if you get some sort of multiple expansion, if you get some sort of margin expansion, you could get actually very reasonable or attractive returns, maybe even 15 to 20% annualized returns over the coming years for Dollar General. So relative to many other stocks, I personally like Dollar General. I don't think it's going to be part of my investment journey because I'd rather have something where it's very clear, like, hey, here's the growth driver that's going to drive hundreds of percent upside over time. Whereas this is more a situation about, well, what's the cash flow that I can get and could I get a valuation rebound? So maybe if you were to get an even lower multiple and say, hey, now I'm paying closer to 10 times normalized free cash flow, and if it were a rebound to 15 times earnings or 20, then you're looking at 50 to 100% upside. Then it might start get, more compelling for the super deep value investors. I also, the part that I haven't covered yet in terms of growth is they have considered opening new stores in northern Mexico. Very curious if this, works for them and could become a new growth engine for them. I would need to see more data on that. Also data translating into a higher growth rate where, they could say, hey, not only is this working, but you can see it with our results. And right now, I think it's just too early to tell, like, oh, this is actually going to be a growth driver for this business. So right now I'm looking at Dollar General, still thinking, it's a low single digit type growth from here. You're going to have, buybacks and cash flow return to shareholders. But broadly, relative to many other stocks, I like Dollar General. I like the recurring nature of their business. I like the fact that a lot of consumers go to it because they effectively say, "Hey, I'm priced out of a lot of other options," so they're appreciative of having it available. I don't think it's unrivaled, but I do think it'll hold its market share and potentially take market share from some of the big box retailers over time. And if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.